Next question. Following are the financial statement of A Limited and T Limited for the current financial year. Both the firms operate in the same industry. So it is a kind of horizontal merger. Okay. Both of them are doing business of the same kind. Information is provided about the current assets, fixed assets. Total of all of them, that is both of them, is total assets. Equity share capital is given. Retained earning, that is reserves and surplus, is given. Long term debt is given. And total current liabilities have been given to us. Income statement is given to us, wherein sales is given, COGS, cost of goods sold, is given. Difference of both of them is gross profit. Operating expenses and interest is given. So it is earning before taxes. Minus tax at the rate of 35% is earning after taxes. Additional information is given to us with respect to the number of equity shares. Then dividend payout ratio is given. So it is 1 minus B. That is given to us in the question. So basically, we can compute the retention ratio also. Dividend payout is 40%, so retention ratio is 60%. Dividend payout is 60%, so the retention ratio is 40%. P0 is provided to us, that is the current market price of the equity share. Assume that two firms are in the process of negotiating a merger through an exchange of equity shares. You have been asked to assist in establishing equitable exchange terms, and you are required to decompose the share price of both the companies into earning per share and the price earning components. Segregate the EPS figure into return on equity and book value or intrinsic value per share component. Estimate the future EPS growth rate of each of the firm, and so on. The questions have been provided to us. I request all of you to go through the question and then we'll discuss how to do answer. Just you are requested to go through the question, all of you. Now friends, in the first part of the question it has been given, decompose the share price of both the companies into EPS. Means you have to calculate the EPS. How you can make the calculation of EPS? You can understand it very well, friends, that earning after taxes is 2,10,000. The same will be divided with the number of equity shares. Number of equity shares are 1 lakh. That will give us the earning per share 2 rupee 10 paise. Then price earning ratio. Market price of the share is 40 and the earning per share is say 2.10. So the price earning ratio is 19.0476. That is the way the price earning ratio can be found. Also segregate the EPS figure into return on equity. We understand that as far as the net worth is concerned, net worth is an amount of rupees 12 lakhs. Earning after taxes is 2,10,000 divided by 12 lakhs into 100 for getting answer in percentage term. So the final answer is 17.5%. This is the way the return can be calculated. Then the book value per share. Then again we understand that the net worth is rupees 12 lakhs. Number of equity shares are 1 lakh. So book value per share is rupees 12. Next is the calculation of the growth rate. Dear students, the growth rate is calculated as B into R. B stands for the retention ratio. We understand that the retention ratio is 0.6. Rate of earning is just calculated by us 17.5%. So 0.6 into 17.5. So product of both of them is 10.5%. This is the way we are required to make the calculation of the answer for the first and the second part of the question, wherein only the basic details are required to be calculated, nothing else. Nothing is great to be done in the first and the second part of the question. Calculation of the EPS, calculation of the price earning ratio, calculation of the return on equity, calculation of the book value per share, calculation of the growth rate, and so on. These are the basic things that we are required to compute, so for both the companies, say before merger. So first of all, we'll complete the first and second part of the question, and then we'll proceed for the third part. So let us answer the question. Calculation of earning per share, comma, book value per share, comma, growth rate, and such other details. See, there are two companies, A and T. As far as earning after taxes is concerned, for A company it is 2,10,000. Next is the number of equity shares, 1 lakh. Earning per share is earning after taxes 2,10,000 divided by the number of equity shares, 1 lakh. That comes to 2 rupee 10 paise. Market price of the equity share is 40. So price earning ratio, it is calculated as MPS upon EPS. So 40 rupees divided by 2 rupee 10 paise. That comes to 19.0476 or 19.05 times. That is the way we can make the computation of the price earning ratio. The next is calculation of the return on equity. That is R. It is earning after taxes divided by net worth. Okay, what is the earning after taxes? It is 2,10,000 divided by net worth. Net worth is an amount of equity share capital is 10 lakhs and the reserves and surplus is 2 lakhs. Yeah, this is 10 plus 2. So 2,10,000 divided by 12 lakhs, 17.5%. Book value per share. It is again net worth divided by number of equity shares. Net worth is 10 lakhs plus 2 lakhs divided by number of equity shares are 1 lakh. So 12 upon 1, that comes to 12 rupees per share. This is the way the book value per share can be calculated. It is also what we understand is the intrinsic value per share. Afterwards, we'll make the calculation of the retention ratio. As far as the retention ratio is concerned, it is 1 minus dividend payout ratio. That is 0.6 because retention ratio is 0.4. I'm sorry, dividend payout ratio is 0.4 for the first company. Dividend payout is 40%, so the retention is 60%. So finally we will compute the growth rate as B into R. B stands for retention ratio 0.60 into 17.5%. That comes to 10.5%. So the growth rate is 10.5%. This is the way growth rate can be calculated. This is the answer of the A limited point of view. I request you to do the entire working from T limited point of view on your own. Now for the target company, we have to make the similar working. Earning after taxes is given. Number of equity shares are given. That will give the EPS. MPS is given. Divided by EPS is the price earning ratio. As far as the net worth is concerned, it is only equity share capital 8 lakhs. Divided by number of equity shares, that will give the book value per share. Earning after taxes divided by net worth will give the return on equity. We have been provided with the information about the dividend payout ratio. So 1 minus dividend payout ratio is the retention ratio. Growth rate is equal to B into R. That is the way we are required to make the calculation of answer. So I request all of you to write down answer along with me. Earning after taxes, that is 99,000. Number of equity shares are 80,000. So 99,000 divided by 80,000. That will give EPS. It is 1.2375. Market price of the equity share is 1515. So the price earning ratio will be found as 15 upon 1.2375. That is 12.12 times. Return on equity, it is earning after taxes 99,000 divided by equity share capital plus reserves and surplus. However, there is no reserves and surplus. So it is 8 lakh rupees itself. So 99,000 divided by 8 lakhs into 100. 12.375. Book value per share, it is 8 lakhs divided by the number of equity shares, that is 80,000. So book value per share is rupees 10. Dividend payout ratio is 60%. So 1 minus 0.6. So retention ratio is 0.40. Growth rate is 0.4 into 12.375. It is 4.95%. That is the way the growth rate is calculated. This is the way the first and second part of the question answer can be calculated with respect to the basic details for both the companies. Next question. Based on expected operating synergies, A Limited estimates that intrinsic value of T Limited's equity share would be 20 rupees per share on its acquisition. Means the question says that the acquiring company can afford to pay 20 rupees per share for acquisition of the target company. You are required to develop, highlight the portion, range of justifiable equity share exchange ratios that can be offered by A Limited to T Limited shareholders. So we are required to compute that, say, what is the range of the exchange ratio that can be offered by A Limited to T Limited shareholders. Based on your analysis in part 1 and 2, would you expect the negotiated terms to be closer to the upper, that is whatever the range that you find, or lower exchange ratio limit, or the lower limit, whatever you compute? And further you are required to give reason that, say, why do you feel like that? So basically over here, say there are three questions which we are required to answer. First is, we are required to compute that, say, what is the justifiable equity share exchange ratio, in a way that, say, between what range the exchange ratio will fall. That is the first question. Second question that say we are required to answer is that say you are expecting the exchange ratio to be near to the lower exchange ratio limit or near to the upper exchange ratio limit. That is the second question. And the third question is that say you are required to substantiate, you are required to justify that say why do you expect the exchange ratio to be near to the lower or near to the higher exchange ratio limit. I want you to tell me in the chat box that say what is the justifiable equity share exchange ratio considering the information given. Now friends, we understand that from the target company point of view, they know that so the market value of their own independent share is 50. There are 80,000 number of shares. So the present value, market value of T Limited is 15 rupees per share into 80,000. That is an amount of rupees 12 lakhs. So target company will not accept any value, any consideration which is less than 12 lakhs. That's very much clear. Market price of the acquiring company share is 40 rupees. Means one share is equal to rupees 40. So how many shares are required to be issued for discharging the consideration of 12 lakhs? That is a question. And answer of the question is very simple. 12 lakhs into 1 is going to remain 12 lakhs divided by 40. That comes to 30,000 shares. So this is the number of shares that will be issued by acquiring company for acquisition of the target company. Listen carefully. Issuing 30,000 shares against 80,000 shares means the target company will not accept any exchange ratio which is less than 0.375. And this answer can also be calculated by simply taking into account the market price of the equity share of both the companies before merger. That is MPS of the target company upon MPS of the acquiring company. And this is what we understand is the minimum exchange ratio which the target company requires in acquisition process. Importantly, the question is providing the information that based on expected operating synergies, means looking to the future advantages. A Limited estimates that intrinsic value of the T Limited's equity share would be 20 rupees per share on its acquisition. Means acquiring company believes that say we can afford to pay an amount of rupees 20 per share. So listen carefully. 20 rupees per share into 80,000 shares. So that comes to an amount of 16 lakhs. Issuing one share is equal to an amount of rupees 40. So this is the number of shares to be issued for consideration of 16 lakhs. In a way that say we can afford to pay 16 lakhs. So it is 16 lakhs into 1 divided by 40. So we can issue 40,000 shares. Issuing 40,000 shares against their 80,000 shares means what we can afford to issue? We can afford to issue 0.50. Means again the simple working is there. We can afford to pay 20 rupees per share for their one share. My equity share has market price of 40. So 20 upon 40 is 0.5. It means that we understand 0.375 to 0.5. That is what say we understand is a range in which the exchange ratio is going to fall. That is what we understand. So we understand that say justifiable equity share exchange ratio is between 0.375 to 0.5. Now the question says that say that what do you think that the exchange ratio will be near to 0.375 or it will be near to 0.50? So looking to the answers that we have computed in the first and second part of the question, we are required to give answer that say what do you expect the exchange ratio to be near to 0.375 or near to zero point 0.5. I request you to give answer in the chat box along with the reason. Dear students, the answer is 0.375. Why? Because friends, we understand that as far as the acquiring company is concerned, acquiring company is having such a stronger position in comparison to the target company. You can see that the earning of the acquiring company is higher, its earning per share is more, its market price per share is more, its price earning ratio is more, its return on equity is more, its book value per share is more, its growth rate is more. So everywhere the acquiring company is having such a stronger financial position. Since acquiring company is having stronger financial position, it will be able to keep the exchange ratio which is in favor to them. It means that the exchange ratio will be near to the lower limit. And what is the lower limit? Lower limit is 0.375. That is what we understand. So write down answer for the third part of the question. Range of exchange ratio. In that write down minimum required and maximum affordable. Minimum required is MPS of T divided by MPS of A. MPS of T is 15. MPS of A is 40. So it is 0.3750. Maximum affordable to A. In that, intrinsic value of T divided by MPS of A. Intrinsic value of T is 20. MPS of A is 40. That is 0.50. So we understand that say the justifiable range of the exchange ratio is 0.375 to zero point 0.5. Right an answer. Justifiable range of exchange ratio is 0.3750 to 0.50. This is what we understand. With paragraph write down, we can observe that A Limited has strong financial position, comma, its earning per share, comma, price earning ratio, return on equity, book value per share, growth rate are higher in comparison to T. Full stop. So A Limited will be able to negotiate for exchange ratio lower so far possible, that is near to 0.3750. This is what we understand. Fourth part of the question, based on 0.4 is to 1 exchange ratio and assuming A Limited's pre-merger price earning ratio will continue after the merger. Question number 1, estimate post-merger market price of the share. Question number 2, show the resulting appreciation, that is increase, or dilution, that is decrease, in the pre-merger market prices. So the question says that there are two things that you are required to find. One is the MPS, and second is you are required to compute that the post-merger the market price of the share is greater than the pre-merger or not. We are required to make this calculation with an assumption that the price earning ratio of A Limited itself is the price earning ratio of the merged firm. Try to calculate answer and put your answer in the chat box. So friends, over here, for the fourth part of the question, we are required to work out the answer like this. Working note number 1, calculation of the MPS of the merged firm. As far as the MPS of the merged firm is concerned, it is EPS of the merged firm into price earning ratio of the merged firm. What is EPS of the merged firm? That's again very simple to calculate. It is earning after taxes of A plus earning after taxes of T divided by number of shares of A plus number of shares of T into exchange ratio. That will give the EPS into price earning ratio of the merged firm. As far as the earning after taxes of A is concerned, it is an amount of rupees 2,10,000. Earning after taxes of T is 99,000. The price earning ratio of A Limited is 19.0476 or 19.05. That is MPS of A divided by EPS of A, which we already have calculated above. So we understand it is 2,10,000 plus 99,000 divided by number of equity shares of A Limited are 1 lakh. Number of shares of T Limited are 80,000 into exchange ratio is 0.40. And you can see that so the 0.40 is given to us near to 0.375. Okay. Into 19.05. So into 19.05. That is the way we can make the calculation of answer. So it is 80,000 into 0.4, 32,000 plus 1 lakh, that is 1,32,000. 2,10,000 plus 99,000, 3,09,000 divided by 1,32,000 into 19.05. That is 44.59. That is the way MPS of the merged firm can be calculated. Once we compute the MPS of the merged firm, we have to compute the profit or loss to shareholders of the each firm. So calculation of profit or loss to shareholders of each firm. It is A Limited and T Limited. In that say we are required to make a comparison of the post merger with pre merger. Post merger, in case of A Limited, it is MPS of the merged firm itself, that is 44.59, and for T Limited it is MPS of the merged firm into exchange ratio, so it is 44.59 into 0.40, that is 17.84. It is required to be compared with pre-merger. Pre-merger it is 40 and it is 15. So pre-merger prices are required to be compared with the post-merger to find profit or loss. It is 4 rupee 59 paise and it is 2 rupee 84 paise. That is the way the profit or loss to shareholders of each firm can be calculated. So let us have a summary of the entire answer. In the first and second part of the question, friends, you can understand you do not require the knowledge of mergers. You do not require. Even though the question is about the mergers acquisitions, you just have to calculate the EPS, book value per share, price earning ratio, growth rate. So just by applying the concept that you have studied at your second level, you have to make this basic calculations. Nothing is great in that. What I want to tell you is that, say, from examination point of view, suppose you have not done any of the chapter and still there is a question from that chapter, you just have to see, can you do that question with the knowledge that you have with the some basics of the financial management? If yes, you can do it. First and second is simple. Third question is important, wherein we are required to compute that, say, what is the range in which the exchange ratio will fall, starting from the lower to the upper. So minimum required exchange ratio is MPS of T divided by MPS of A, and maximum affordable exchange ratio is intrinsic value of T divided by MPS of A. That is 0.375 to 0.50. The reasoning that, say, why the exchange ratio will remain to the lower one, that is near to the lower one, is also important. Why? Because we understand that, say, 0.37, that is acquiring company is having such a stronger financial position. So it will be able to negotiate better and it will be able to keep the exchange ratio low so far possible. That is the reason. Next is simple calculation of the MPS of the merged firm, and say calculation that, say, what is the profit or loss that, say, the shareholders of each of the firm will have. Only the third part of the question is tricky in this question. Otherwise, solving the first, second and fourth part of the question is extremely simple in my opinion.